Welcome back. I'm Art Espinoza. I'm the host of the Art of Investing. Thanks for tuning in. All right, just to summarize my first half of the program, I talked about that I believe that rates are going up because the Fed thinks they should. I'm not so sure the market, the stock market has priced it in. So be careful out there. Markets are at, for the most part, all-time highs. And I don't know that we're not going to see some turbulence down the road. I don't think it's going to be a long apocalyptic type of thing, but stay tuned, keep it tuned in here, and you'll be okay. I am not going to use the word apocalyptic anymore. That was it for the program. That's a tough one on radio. But that's where I think. Fed probably September, December, they're going to raise the rates. The markets might get jolted a little bit, but I think we'll be okay. So just keep tight. And remember, don't ever sell in a market downdraft, and be careful if you're going to buy in a market uptrend. Wait for things to settle down. Okay, Wells Fargo posted their second quarter earnings, which came in at flat, and so were their revenues. And now you're probably wondering, why am I discussing Wells Fargo? Well, it's a core holding of the Art of Investing Index, and as is Comcast, which I'm going to touch on a bit later. And the Art of Investing Index is comprised of ExxonMobil and Volkswagen, and I believe it's Comcast and Pepsi. All right. Wells Fargo, in case you didn't know, is the fourth largest bank in the country and biggest when it comes to mortgages. And I just touched on that. Right now, it's been tough sledding for not only Wells Fargo, but the rest of the banking industry. And things are changing, though. Now, we just finished a hearty discussion on what I think the Fed probably will do in a few short months. Raise interest rates. So how do you play that? I mean, this is the art of investing. Art, what do? I've got a portfolio out there. They're raising interest rates. Normally, that's bad for stocks. Yes, it is, for the most part. The short end is going to go up, and things are going to get jolted a little bit. But I think, and like I said, I really think that the banking industry stands to weather the potential storm better than most sectors, Wells Fargo included. Here's why. The banking industry has been dealing with this low interest rate cycle we've been in for the last 6 years, wouldn't you say? And therefore, their net interest margins have been squeezed over that same time period. And net interest margin is the metric used most to determine the profitability of a bank. They take in deposits and they loan out those funds. And the interest rate that they pay out on the deposits that you and I put in there are, as you know, next to nil. But the interest they are receiving from the loans that they have are just as low. They're just as, you could say, nil, but a touch above nil. Add to that the many restrictions placed on banks currently, not the least of which is who they lend money to. They have to loan to the best to the best risks, because right now today they have to hold on to a majority of the loans, the mortgages. Back in the day, before the real estate market tanked, what banks would do for the most part, they'd give you a mortgage pretty much regardless of what your credit looked like, and because they knew that they were going to package that loan and get rid of it before you even walked out the door. That loan was gone. They can't do that anymore. They have to hold tight. There's a certain percentage that they have to hold on their books. So they're going to make doggone sure that you're a good risk. And they're not going to hold on to they're not going to loan to someone who might be on the margins, if you will. So when you add all that together, it's been pretty tough for the banks to make money as far as the net interest margin is concerned. They're taking in money, deposits. That's what they use. They use that to loan money out, and I think things are changing as far as that is concerned. Now, when the Fed eventually raises rates, banks traditionally are slower to boost the rates that they pay you and I in our savings accounts, but they're a little quicker to raise them on new loans. Hence, increasing net interest margins should increase profits and hopefully the price of the stock. And by the way, let me just simplify that for you. The rate right now, the difference between what they're taking in, let's just say, for example, you go into Wells Fargo and they offer you a 0.01%, and that's not out of the question. That's pretty close for your deposit in your savings account. They're probably going to loan that money out at somewhere, as far as Wells Fargo, their number is 2.98%. So the spread is 2.98% by what they're taking in, paying you and I, and what they're loaning it out as. They'd like to see that number at around 3.5. And I think over the probably 6 to 12 months, they're going to do that. They're going to accomplish that. And that will only help their bottom line. And if their bottom line is improved, so will the price of the stock. And don't forget, the price of the stock, it's sitting at 57, just under 58, is yielding a 2.7% dividend. Now, we bought the stock. We added the stock in the Art of Investing Index. If you had listened in October, we bought it at $58 and change a share, just in October. And it's already just under 58. And I think going higher. Plus, you've been getting about a 3% dividend. In a sign that Comcast is adapting to the way consumers view programming today, they are set to roll out later this summer a live stream bundle, or what we would call television over the web. It will enable those who wish to cut the cord, remember I went over that last week, to buy in at a reduced rate with a $15 per month. That's a reduced program package. It's not I got about 900 programs that I could choose from, in which I use about 3 or 4 a month, but I pay about $50, $60 a month for that. Comcast is saying, okay, instead of you just leaving us totally, we want you to stay, Arthur, but what we're going to do is we're going to offer you $15 a month. We're going to get rid of the $50 a month for you. We're going to offer, because you are our broadband customer, and you have to have broadband for this program. And don't leave us totally. For $15 a month, we're going to allow you to watch HBO and all your local programs for $15 a month. And I can watch on any device that I choose. I'm not sure I'm going to cut the cord that much yet, because there are some programs that are not included there. But I could watch Fox on my computer without Comcast, other than them bringing the internet. I could watch CNN, CNBC. I literally can watch the live programming on my computer, and all I really need Comcast for is to bring the internet into my house. But you see, that's huge. I think Comcast is smart in what they're doing. That's why I like this company. That's why I put the company in the Art of Investing Index last week at $63 a share. It's $64 a share. Folks, I think this is a huge, huge company to own going forward. Now, the drawback right now to that program is they're only offering it they're testing it in areas that anyone who lives in Chicago, Boston, or Seattle. And those are major markets that they're going to utilize this program and see how it works. Now, maybe by the time it gets here to South Florida, it might look a whole lot different. But it's the idea that they're moving with the times. I love companies. I love management that moves with technology. They're not resting on their laurels. And you get that diversification. Remember, I like this, diversification within a company. So you're going to get the broadband, the internet, bringing the internet into my house. I have to have that. So I'm going to pay them their $80 a month for that. Now they're offering me, or they will be in probably a year's time, that I can reduce the amount of what I pay for all the channels. Well, over the next year, and I would suggest you do that too if you're a Comcast, if you have Comcast as your provider, I would start to see how many programs you watch, because they're going to be sending you letters. They're going to be updating this program, and by the time it gets down here in Florida, you might be able to say, you know what, I watched 4 programs that all I need is the internet for. I really don't need Comcast bundles. But you know what? I would like my local channels, and I do like HBO, which a lot of people do, for $15 a month. I do know if you go to HBO yourself and you try to get it without Comcast, you're going to pay about $15 a month anyway. So they're throwing in the local channels for free. My point is this: we own Comcast in the Art of Investing Index, and I'm going to own it for a while. And by the way, they have a 1.5% dividend while we wait for all this to happen. Comcast is going to stay on the cutting edge of technology. They're proving it now. They know that people are going to try to cut the cord. Well, they're dangling us a carrot. I might bite by the time it gets here. That's why I love Comcast right now. I think it's going to be one of the biggest winners in the Art of Investing Index. But before you do anything, always call your broker, or like I said earlier in the program, contact me via my website, and we can talk about it. Don't just do it. Just be careful when you make any kind of investments. Talk to whoever, but Comcast might be a name, or it is a name you should look at. And, okay, what else? It looks as though Greece has come to terms with the ECB, which is the European Central Bank, and the International Monetary Fund for much-needed funding. Not only that, Germany's on board with the agreement, and I'm sure before long the public will trade common sense for gas bombs, and everything else will be kumbaya. I told you there was no need to worry about what was going on in Greece. I said that last week. China's who you really need to pay attention to. And finally, Iran has agreed to terms to what is dubbed the Vienna Accord. There is still much to be debated, and that's for someone's political show, which this is not. However, if the deal passes Congress's approval, and this is important, and it's important that you understand this, it will add another 1 million or so barrels of oil to an already oversupplied market. The question remains, and as it is with all commodities, on whether or not demand will be there to absorb the excess oil.